Steve Liesman has the numbers right now.
Yeah, Joe, 152,000, a little bit below the expectation for the ADP, which is the consensus out there, but also a little bit below the estimate for the payroll on Friday. Take a look, 152,000 with all of the jobs, or the bulk of the jobs in the service sector, 149,000, just 3,000 in the goods sector. Actually, a big decline in manufacturing jobs. April ADP was revised down slightly from 192 to 188, and it's not been doing really a bad job, Joe. Errors are between 48 and minus 25. So in that range of plus or minus 50. Let's take a look at how we got there. Small business down 10,000. Medium-sized business up almost 80,000. And large business 100,000. Looking at it by industry, trade, transportation up 55. Educational services, that's where we see a lot of the jobs in the BLS report as well. Up 46. Construction up 32. Leisure and hospitality, not as much before. And there's that decline in manufacturing jobs, down 20,000. Interesting movements in annual pay. Job stayers getting 5% wage. That's still on the high side, but unchanged from last month. Job changers up 7.8%. That's down from almost 9% or above 9% in the prior month. It is down for the second month in a row. So we'll leave it there, guys. We'll see what it says about whether or not this suggests maybe a lighter BLS number on Friday. But it's been in the range, Joe, this ADP number.
It is. Steve, stay right there. Let's bring in Nela Richardson, chief economist at ADP. Steve said 190 for Friday. Nela, does that sync up with what's reasonable in your view?
Yeah, I think it's going to be lower, Joe. Good morning.
You do.
This number is generally a good number, plus 150,000 or so jobs in most economies is a great number, but there is a little weakness under that hood. There's weakness coming from traditionally white-collar jobs like professional business services we saw loss, information services we saw loss. We also saw losses and weakness tied to both producers when it comes to manufacturing and consumers when it comes to leisure and hospitality. That 12,000 jobs number is lower hiring than we've seen in the previous 2 months, which have been strong. So overall, it's a good number. It's not a great number, and there's some weakness that we're really paying attention to.
The Fed probably not unhappy with maybe a little bit of cooling in the labor market. Is that the right move, Nela? I mean, will this tighter environment bring inflation down? If it's not going to bring inflation down, there's no reason to try and hurt growth or the labor market. So I hope we get something for this.
Yeah, right. What's the point? I think we're looking to see whether we can coast with our steady hiring through the summer or if the economy is actually running out of gas. Right now, the coasting seems most probable if you look at the other data. But I will note that even in weak sectors like manufacturing, we've seen pretty strong jobs growth when it comes to job changers, up around 11% if you go from one job to another, even in manufacturing. Wage growth for job changers in May is still higher than it was in January. So the pay growth is still a big part of the story. We can't count it out, and we can't count out the role of wages of keeping inflation higher than we'd like it to be.
Can you guarantee me we're going to get to 2% in the next 2 years on inflation?
Not my job, Joe. Sorry.
What do you think, though? You don't have to, but I worry. I worry that the goalposts need to be moved. There may be some structural post-pandemic issues, and if they just are dead set on that, I don't know. They would have to cut by saying it's coming, but they'd have to cut before they hit it.
What I think is when I look at the data, I've seen that the pandemic trends, those dynamics had a permanent imprint on the distribution of the workforce. It's made the workforce a little bit older in some cases by really hitting those younger workers hard. It took a lot to get low-skilled workers back into the labor market. It had an impact when it comes to gender because women are over-indexed in those customer-facing industries. All of those distributional changes affected pay growth. And so my view is we may get to 2%, but we can't rest on our laurels once we get there. The workforce has changed, and our bouts with inflation are likely to have changed as well.
Steve.
You know, I keep thinking about the sacrifice ratio, Joe. How much do you want to give up for 0.65? And I'm trying to think, if I'm Powell, and I say, you know what? I every day that goes by, I get closer and closer and more in danger of risking a recession, trading off my concern about my credibility. And I don't think at some point you have to say, you know what, I'll give up some credibility to avoid the recession. Talking to a bunch of folks in the real estate business last night, there were some pretty serious concerns, and I guess you're going to talk to Barry Sternick later on this morning, which I'll be listening very closely to, because we don't know how bad the office market is. We don't know, how much weakening there is going on. You've seen real incomes have started to come flat now. So to me, I'm looking at the softness in the data now, Joe, and this gets back to something you and I were talking about in the last hour. If the first part of the inflation decline was supply, is this part right here, is this the higher rates starting to bite? Are we at the beginning of that and the slowness there? So that's my concern right now. I would take out some insurance against the downturn at this point.
All right, Steve. Nela, you're nodding it. They're telling me we got to go, but that wasn't really a question, Steve. So, but Nela, you want to just respond for 10 seconds? Or?
I think opening up what Steve says makes sense. When you look at the numbers, again, great headline number, but weakness underneath. And we need to make sure that weakness is not sustained through the summer, because if it is, it puts us in a very different jobs market backdrop for that inflation policy than we are going into the year.